And what he means for those that are new to this insurance conversation, what he means is when we talk about the cap. So in the IUL, they talk about the 15% cap, 12% cap, and actually during the one of the greatest bull runs in the market, which means the economy of America was doing absolutely amazing. During this long ASS run, the cap rates were coming down.
Mm. Yeah.
so
Yeah.
so y'all got to understand the IUL started off illustrating 15, some even freaking 16%
Well,
uh
yeah.
uh caps,
16.5% cap rates in 2010.
16 and a half,
Yeah.
and during one of the greatest times in US history, it goes from 16 to some or even down to 7.
I was totally. I was just interviewing Bobby Samuelson the other day, and in that and this guy, if you don't know Bobby, he's like the wizard when it comes to understanding products like this.
Yep.
The cost of a 10% cap. So basically, that's like you have to set the expenses because of the options cost and the options budget and all that stuff. Well, this is just the options budget. The cost of a 10% cap back in 2011 was 3.9%, meaning if your general fund earned 3.9%, which back then it was earning a lot more, you could have a 10% cap. So that's why cap rates were higher. Right now, today in 2023, the cost of a 10% cap is 5.1%. Okay. And so most companies are doing 4 to 4.5. That's why we're seeing caps come down. Now, a lot of
That's right.
companies will offer higher cap rates only to reduce them later. And they're doing that on purpose. And they're writing off the difference as marketing expenses and business
Yep.
acquisition expenses.
Yep.
And that's just part of it. I saw a question here. I want to answer this because I think it's really important. And it's kind of pivoting a little bit, but why all whole life if it's a long-term instrument when comparing the returns of max funded VUL versus fixed whole life side? So variable universal life will always win over the time if you got the stomach for it. So I think here's the reason, because when we talk about VUL, versus whole life insurance, or whole life insurance versus investing directly in the S&P 500, or whole life insurance versus real estate, or whole life insurance versus any other investment, every other investment is going to get a better return. And you have to look at the difference in the function of risk, right? Like there is no risk in a whole life policy if you fund it properly. There is risk in a VUL. Will it outperform? Probably, potentially, but it's not checking the right boxes, right? It's not solving the same problems that whole life solves. And I'm a big believer we need to focus on financial structure, not just chasing returns, not just trying to
Yes.
maximize returns. We need to build our
Yes.
emergency funds. Americans are massively, wildly undercapitalized. There's a massive lack of liquidity, a massive lack of access to capital when we need it for opportunity. We need to build our emergency funds. We need to build our opportunity funds. We need to build our business reserve capital. We need to prepare for opportunity, because when we have that money available, Jake said it earlier, the whole life policy is simply a warehouse for your capital that you save on a guaranteed basis that will grow and beat inflation long term. And then you borrow against that. That's why I wrote the book Cashflow Hacking. You borrow against that money, invest in other cash flow assets, invest in businesses, invest in things you understand. Don't put your money in assets that you don't control. I'm a
That's
big
right.
believer that we are where we are in life because of who we are in life. Most people
That's right.
suck with money. Most people have a horrible relationship. Most people don't understand with money. If you want to get better in life and better with your money, stop outsourcing the success of your money. Just step into just being massively accountable for the results in your life. And that all comes with saving first, but saving with the intent to invest. And if we're talking about saving, not investing, we always have to start with whole life. And I'm not saying VUL is bad for the right person, because I don't believe it is. It's different than IU. I don't have a problem with VUL. I have a problem, though, that VUL, I think, is prematurely sold in most situations.
Yeah, I think that I think that when it comes to we're talking about building wealth. And wealth is subjective
Mm-hmm.
to the needs and the desires of every person, every family. In my opinion, wealth is your ability to get or do whatever you need or that you want within reason. And it's not a you don't have to budget for it. It's there. Like, you don't have to go through it. It's there. You can go through hell and hot water for 2-3 years, and your reserve is there to protect you. And here's the biggest piece that I want everybody to understand. So many of us are trying to there's a couple of things. Another agent, or a reason why you need to stop messing with an agent, is when they're trying to get you to get into an insurance product to skip the art of asset investing. And when I say asset investing, I know that policies that we talk about are in assets. But when I'm talking about assets, I'm talking about businesses, real estate, land, acquisitions. I'm talking about really investing to make money. Now, before you get to investing, you have to master earning. You got to master making the money.
Yeah.
Then storing the capital so that you can invest it when you know what you're looking for, when you know what you're looking to get into. And there's so many of us that are just trying to skip the steps.
Yeah.
You cannot skip the step. And this is why listen, if everyone just were to take a step back, remove emotion, and think logically. When you think about the concept of banking, it is a surefire way of wealth creation. Here's why. Banks hate risk.
It's true.
So to say that you're practicing infinite banking, private banking, secret banking, your banking, bank of this, whatever it is, and you're incorporating high levels of risk.
Yeah.
Unnecessary fees that can be changed per the contract you signed at will. That is not logical at all, and it's only an emotional decision. But when you pull the caps back, we're like, man, I just want to put my money in something and not work. That's what it is. I want to put my money in a vehicle that's just going to do something for me, and I don't have to look at it. I don't have to study the game. I don't have to study the industry. I don't have to study the product. If you're investing your money into anything, you must study the product, period. And the product could be an insurance product. The product can be a business product. The product can be a real estate product, an asset. I look at all asset classes as products. And if you're not studying that product, you're going to get just completely destroyed no matter what. We're trying to skip the steps, Chris. And the step is rule number 1, earn money. Get good at earning. Number 2, get good at reserving your excess capital. So many people are trying to invest money, and you're negative as far as your own household and being profitable. You're not even profitable taking money home from your job. At the end of the year, we're depending on refund checks and swiping cards to fill the gaps of our inefficiency and learning how to earn money and keep the money that we make. Simple. Earn and keep. If people just practice increasing your skill set to earn more money, dumping your surplus cash into a dividend paying whole life insurance product, it is simple. It's not sexy. It's not cute. It don't give you the feels. It don't make you feel like you're doing anything. But wealth is boring. It's ugly. It's simple. It's doing the same thing over and over again, because when you make money, you don't want to go back to what you used to work, where you came from, to get to where you are. And what you're going to do, you want to encapsulate your wealth so that when you make a decision to actually invest, you can make the right decision. Warren Buffett said, I don't look to get into the market every day. I look to be right 4 times a year. 4 times. That he says, before I've read countless amount of annual reports for eons and eons of time before I decide to invest my money anywhere. I guarantee you, if these clients just did their own due diligence on the product that they're putting thousands of dollars into, just do your own work, you're going to realize what a terrible mistake it is to make an IUL your first, second, third, fourth, or fifth stop. because it just doesn't make sense. If you want to get index gains, or if you want to get investing gains, how about you learn the stock market? Go gamble there. How about you learn buying and acquiring businesses and growing them and grooming them? How about you learn the real estate game? Go into these asset classes that are known for increased capital appreciation versus the other.